Hi everyone, welcome to the session. In this session, I'll be discussing about IAS 2 inventory. I have summarized the standard and I'll be discussing under these main headings, the topic summary and the practical example. Okay, so first of all, let's look at the basis of measurement. How do we measure inventories? Inventories are measured at the lower of cost and net realizable value. Okay, so we measure inventories at lower of cost or net realizable value. Okay, so lower of cost or net realizable value. Okay, let's take a practical example. A retailer holds a stock of electronic gadgets. The cost of each gadget is $300 and the estimated net realizable value is 325. Now here the cost is 300 and the net realizable value is 325. So the inventory is valued at the lower of cost, which is 300, and net realizable value $325, which is $300. Okay, so inventories are measured at the lower of cost and net realizable value, so therefore you have to value at $300. So these are the basis of measurement. Then cost formulas. How do you value inventories? The cost formulas such as specific identification like FIFO and weighted average cost are used to assign costs to inventories. Okay, so basically we can use two methods, FIFO method and weighted average cost method. Okay, I have discussed about this FIFO and weighted average cost method comprehensively. You can go through my videos to understand these two valuation methods. Okay, a simple example, a manufacturing company uses the weighted average cost method to value its inventory. It purchases raw materials at different costs. The batch 1 100 units at 10. Okay, so batch 1 100 units at the rate of 10 and batch 2 200 units at 12. So here the total cost is 1000, here the total cost is 2400. Okay, when selling 150 units, the company assigns the cost based on the weighted average cost of 11.33. So how do you calculate? So what is the total number of quantities purchased? 300. And what is the total cost? 3400. This 3400, if you divide by 300, so that will be your weighted average cost method. Okay, so let's calculate 3400 divided by 300, so that will be 11.33 per unit. So therefore when you sell 150 units, the company assigns the cost based on the weighted average cost of 11.33 per unit and calculates the cost of goods sold accordingly. So therefore cost of goods sold will be 150 times 11.33, so which will be how much? 150 units, so that will be 1700. Okay, so 1700 will be the cost of goods sold. Then how do you determine the net realizable value? Net realizable value is the estimated selling price minus estimated cost of completion, disposal and selling expenses. Okay, so here the net realizable value is calculated by taking the selling price minus estimated cost of completion. Okay, so estimated cost of completion, and if there are any selling price, that also has to be deducted from the any selling price, selling expenses has to be deducted to arrive at net realizable value. Okay, so example, A wholesale has excess inventory of perishable goods. The estimated selling price is 1,300 US dollars, but it will incur 150 in disposal cost. Therefore, its net realizable value is 1,300 minus 150, 1,150. So this is how you calculate the net realizable value. Write downs and reversals. Write downs are required when the net realizable value falls below cost. This is what we discuss. Okay. If the net realizable value is below cost, then you need to recognize at net realizable value. Okay. So this is what we discussed, the measurement, the basis of measurement. Write downs are required when the net realizable value falls below cost, and reversals are possible if the net realizable value increases subsequently. Okay. So if the net realizable value increases subsequently, you can reverse the cost. For example, let's say a company holds inventory of electronic devices. Due to changes in technology, the estimated net realizable value of certain models decreases below their cost. The company records a write down to reduce the inventory value according to this measurement. Later, if the market improves, the net realizable value increases, the company may reverse the write down. Okay. For example, let's say the net realizable value of an item is, let's say, $10 and the cost is 12. So you need to value lower of cost or NRV, so you have to value at 10. So subsequently, let's say the NRV is what you call is 10 and the cost is 9. Okay. So you need to value at lower of cost or net realizable value, which is at 9. Okay. So this is what you need to calculate based on this write down and reversals. Disclosure requirements. Disclosures include accounting policies, carrying amounts, and any circumstances leading to write downs or reversals. Okay. So this has to be included in the disclosures. A manufacturing company discloses its accounting policy of using the weighted average cost formula for valuing inventories. So if the company uses weighted average cost formula, it has to be disclosed. It provides details of inventories carried at different classification and explains any significant write downs due to obsolescence or market declines. Okay. If there are any decline in the market, or if there is any obsolete items, that has to be disclosed in the notes to the financial statements. Okay. So this is the summary of inventory 2 IAS 2. So this is the summary of IAS 2 inventory. So I'll see you soon with another video with another discussion on IAS, International Accounting Standards. Thanks for watching, and I'll see you soon with another video. Bye for now.